All right, well, we're back, and I've got Doug here again for Weekly Insights. Welcome, Doug.
Thank you.
So, Doug, this week, I've been hearing a lot about this thing called corrections and being in corrections territory. And what does that mean for us and for our clients?
Right. Well, it's a term that the media loves to use because it sounds really scary. Technically, and it is pretty arbitrary, but technically it means the market is down 10% from a peak.
Yep.
So that's really all that a correction is. And whenever we hit it, you will see all of the media sort of jumping on it as this big moment. We're in correction territory, and it does create a bit of emotion out there.
Is this something that is a pretty regular happenstance and something that we've seen often over the course of several years or however long you're necessarily looking at the market?
Yeah, it's not that unusual. If we think about the last few years, in fact, it's probably more unusual to have a year where we don't have a correction.
Oh.
2024 was one of those years we had no correction. The market pretty much just sort of steadily rose. But if you look at 2023, we had a correction. 2022, which was a down year, we had multiple corrections, multiple times where we sort of peaked and then went down by 10%. 2020, obviously, big correction. We all know what caused that. And so if you're looking at those 5 years as representative, kind of one a year.
1 year. Okay.
Yeah.
And is this, I'm sure there's a lot of different factors, but most likely uncertainty is one of the big factors that kind of drives corrections.
Right. Yeah. The market is always trying to price in the best information it has. And when that information becomes uncertain, the sort of default is to pull back a bit. If we don't know what's going to happen, let's take the foot off the gas a little bit. That's going to hit the market. And so when uncertainty rises, that tends to impact markets. That's not always the cause of a correction, but it certainly does contribute.
So then the market is almost reacting the same way. If I was watching the news every day, the market's reacting the same way and trying to anticipate something that it heard on the government shutdown as an example, like, oh, if that happens, we need to be prepared for that by doing X, Y, and Z.
Right. And it's important to say, we always use this term, the market, right?
Yeah.
It's investors,
Right.
There
Yeah.
are millions of investors who are interpreting this data. And if they start to get nervous about what that data says, and sometimes that nervousness is just about, the data is uncertain, right? When that uncertainty rises, there's going to be a bigger discount applied to the market. And that, again, is the accumulation of millions of investors reacting to that information. The market is always trying to, investors are always trying to price in what they think, what they think the valuation of the market should be.
And then does that apply similarly to like consumer sentiment? And is it very similar to that? Like, how does that factor in as well, and how the consumer feels?
Yeah, it is related. Oftentimes, consumer sentiment is a lagging indicator. The market going down kind of brings consumer sentiment down. I actually had a colleague who once said that the only thing that consumer sentiment can predict is consumer sentiment, meaning it's lagging, right? It's a reflection of people's feelings. People's feelings when it comes to the economy are often driven by the market.
And so as we look around the world, what kind of things are we seeing outside of the United States?
Well, we are seeing, in terms of market performance, we're seeing actually really good performance outside of the U.S. And that is coming in two forms for us who are investing here in the U.S. in dollars. It's coming in two forms. One is just perhaps a more positive outlook in the sense that if you think about Europe, for example, it's already coming from a position of being better value. When we think about the U.S., we think about the Magnificent Seven, a very expensive market in general. Europe is sort of the opposite. It is a way to play value. So there's a little bit more better sentiment in terms of valuation. The other thing that we've seen happen is is that the dollar has weakened. And for us US investors, the dollar weakening is going to raise the price of international equities. So we get to be a benefit of that. And year to date, I think that number is somewhere between 4 and 5%.
Yeah. And so from this past weekly insights, and for those of you who don't know, you can read all of Doug's weekly insights on our website under the resources. But you opened up with stocks ended the week in the red for the fourth week in a row, and for the sixth time in 7 weeks. The S&P 500 officially dipped into correction territory. The Magnificent Seven have become the Mediocre Seven, and that's generous. Tariffs are high, and consumer sentiment is low. And you should forget everything I just said.
Right. Right. And really the message there is just don't get caught in the emotion of these headlines. Everything we're seeing year to date, while not fun, is quite normal. We talked about, corrections happen on average once a year. And I should say, when we think about those last 5 years, with those corrections, with the pandemic, investors earned about 17% in U.S. equities per year during that time period. So it's worth taking a step back, remembering that these things happen, but patient investors have benefited from that market going up. And smart investors are going to be those that don't shy away from these markets, but start to see opportunity. Really, the way to think about a market falling is it's becoming less expensive. You would never go to the store and see, the price of your favorite object you're looking to buy falling and being like, oh, forget it, I'm out of here.
Yeah.
You'd be like, oh, right, now's the time to buy, right? And it really is no different with investments, unless you think, structurally, the world is coming to an end. Now, companies, we live in a capitalist country. Companies are here to make profits. They're going to find a way to make profits. So if we start to see the market sell off, look for those opportunities to bargain hunt.
Yeah, and I think you said it last week, and I think it's a repeatable thing, is that from your perspective, it's not that you're looking to tell the future or that specifically that something's going to work out. It's just that the opportunity there is great when stuff starts to fall off, and so buying low, quote unquote, is going to be better than buying when it's already rising, right? And there's the hopes that, and like you said, that most companies are looking to be profitable, so ideally they're going to get back on track.
And the systematic way to take advantage of that is with a diversified portfolio. Again, we didn't predict that international was going to be outperforming the U.S. by so much this year, but a diversified portfolio allows you to take advantage of that. And that systematic rebalancing allows you to sell high and buy low. So as we see international outperforming, when we do a rebalance, we're going to be locking some of that outperformance in, and we're going to be buying whatever's been underperforming. So that's a nice way to systematically take advantage of it. And then if we were to see the market continue to fall to a point where there's a real valuation opportunity, that's when we can get really tactical.
And so, looking to the week ahead, not necessarily, I think after both the conversations of these two podcasts, hey, maybe people listening out there don't look at the market and don't look at the news as closely. But what are we seeing for the next week ahead for the investment team here?
For the investment team?
Yeah.
That's a tough question. I mean, we are always, we're really doing the same thing every week, which is being vigilant, being prepared. That may sound boring, but every day we are trying to prepare for the next day. And that means making sure the portfolios are properly rebalanced, that they are well diversified, that if an opportunity starts to open up, that we're taking advantage of it. And again, a boring answer, but it is the same thing that we do every day, is really just prepare for that next day, prepare for that next week, and be ready for whatever the market throws at us. Again, what we are not doing, and I'll sort of underline it, you said it earlier, we are not predicting what is happening certainly over the next week, let alone the next year. We're just going to take advantage of whatever the market offers us.
Yeah. And I know that was a little bit of a trick question, but I figured I knew the answer to that. But the idea here is for folks at home who are listening, who may be a little stressed out at the news and everything that's going on. It's there's a plan in place. We're following the plan, and we follow it every day the same, and every week the same. That's why it's in place, and that's why we do what we do here.
Right. Yeah. And it's a great point. We do get that question quite a bit. Market's going down. What are you going to do about it?
Yeah.
We've already done it. It is the same thing that we do every day.
Yeah. And it's going back to last week in that evidence-based investing and just really trusting the system and trusting how that works.
Right. Exactly.
Yeah. All right. Well, and Doug, you had a little funny thing in your investment this week about St. Patrick's Day. So what about St. Patrick's Day made you excited this week?
Well, I think you're talking about gold.
Yeah.
So yeah, we like to, joke, hopefully you'll find it, that gold at the end of the rainbow. But if you don't, you will find it in your portfolio. We do have gold in there as a diversifier, and as luck would have it, gold is the best performer, not only on the year, but over the last year plus. It's been a great diversifier.
Great. Well, and again, diversification. So whether or not it is or it isn't, we should be ready for that. So,
right. Exactly.
Moving forward. All right, Doug. Well, thank you so much for your time, and we'll talk to you next week.
All right. Thanks, Jay. Take care.
This podcast is for educational and informational purposes only. Please see the full disclosure in our show notes for more information.